It was another wild day on Wall Street as we saw most of the indices closing lower today. However, the NASDAQ composite once again finished higher, has an all-time high, and even has an overbought cluster signal. Meanwhile, we have strongly bearish postures on the Dow Jones and also on the Russell 2000. So quite the differences in the various indices these days. If you are anything to do with momentum or technology or work from home, those are the hot areas of the market right now. Everything else is kind of being pushed into the back seat. So we'll take a look at all of that, see what it means for our posture. We'll then get into our trade application example, where I wanted to focus on one of those situations where the stock has broken out, kind of taken off without us, wondering if we can kind of take back time and take advantage of a situation where we could focus on that breakout point on the chart. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's July 9th, 2020. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe, check out our description area. Make sure you're signed up for our email distribution list so you can be reminded of these videos and also get the heads up on the stocks that are giving you overbought and oversold cluster signals in the S&P 500. In addition to that, heavy users of Twitter, make sure you're following me. My handle is at Brandon Van Zee. We do encourage you to click like and retweet if you get value out of David and I's videos here, and you want to encourage us to do those as often as possible here for free on YouTube. And then lastly, we do have a presence over on Facebook. Feel free to join our group that you see at the web address in that logo in front of you. All right, let's go ahead and jump into our charts here. And as you can see, I've got chart 4B pulled up here in front of us. And remember, all of you that are premium members of Market Scholars would have access to the 50 plus charts that David and I use in all of our presentations. So this is chart 4B. This will give us a good bird's eye view of what's happening with the various indices. And every so often, people bust our chops about this. Not too much. You guys are pretty calm about things and let David and I handle things the way that we feel is best. But every so often, people feel like we chew up too much time looking at the various indices because, you know, theoretically, all stocks travel together. They all go up together and they all go down together, right? Well, this is one moment in time where you can kind of prove that theory false. And I kind of mentioned in the intro, but take a look at what's going on over here on the Dow Jones and on the Russell 2000. We have dark pink shading on the chart. Now remember, what that signifies is a strongly bearish posture on the Dow Jones Industrial Average, which is the mega cap companies, and the smaller cap Russell 2000 stocks. Now notice on the Russell 2000, we actually have a red moving average as well. In other words, not only do we have a bearish posture according to that green intermediate line on the market forecast technical indicator, but we now have price below a falling 30-day moving average. It probably won't take too long for the Dow to get there as well if we continue to have some selling in the coming sessions here. So kind of take that and also understand that those two areas underperformed yet again today. Dow Jones was down 1.4% today. The Russell 2000 was actually down 2% today. Okay, now with that information in mind, look at the two charts on the left. Now these two charts actually have dark green background colors. So dark pink or dark green. Both of the postures are strong. One of them is strongly bullish, and the other ones are strongly bearish. So the two that are strongly bullish are the S&P 500 and the NASDAQ composite. In fact, the NASDAQ is so red hot, it hit an all-time high today of 10,578. And you'll see this little red dot that showed up above today's candle that corresponds with this red dot down below in the indicator. And that suggests that we have a overbought cluster signal. So the green, the blue, and the red lines are all in the upper reversal zone above 80 on the market forecast on the same day. And you can see that that's actually the first overbought cluster signal on the NASDAQ, at least in the last 3 months. We did have one example of an overbought cluster signal here on the Dow Jones that ended up seeing the market go a little bit sideways and eventually down a little bit. So could this be a time where we get a little bit of a rest? Possibly, but we also have to recognize the trend is very strong. One thing that I wanted to point out here By the way, the S&P 500 was down 0.57 or 0.56 actually percent today, and the Nasdaq was up 0.53%. Now, one thing I wanted to point out was something that I shared on Twitter here a moment ago, so some of you might have caught this already, but to take that conversation a step further, I'm looking for my chart. There it is. This is chart 3D. And this is one of the charts that I use in my factor-based swing trading class. And I said one of these charts doesn't look like the others. And it should be pretty obvious which one that is. And it's the chart in the upper right. This is the momentum factor. And this is effectively the style of trading that I use for my Monday top-down trend trading class for my premium students. And as it were, we actually hit an all-time high in that particular portfolio today. And it wasn't by just a little bit, it was by quite a bit. We had hit, I think it was like 380,000 back in February. So we had a really good run from basically January 1st into the end of February, and then we topped out at around 380,000. Then we had a huge spillover along with the rest of the stock market into March, and then we've been kind of in that recovery mode since then. Today we tapped 385, so we didn't just barely stick our nose above our previous high, we surged right through it. So in other words, on a day when most stocks were down, that momentum-based top-down trend trading account, we saw most of our stocks up and some of them up significantly. So there is definitely a specific niche in this market that is working right now. And a lot of those stocks, like one of them I mentioned to you guys here in this presentation a week or so ago, is DocuSign. That's one of the stocks we own. We try to maintain a portfolio of 25 of the strongest stocks in the market in that particular top-down trend trading class. So DocuSign obviously deserves to be considered one of those companies, as it's more than doubled in under 3 months. But DocuSign, of course, is going to be the type of company that benefits when there is social distancing taking place and people don't want to actually sign real documents. Now, whether the valuation is justified is anybody's guess. What we do know is that the trend is definitely set. The trend is your friend in a company like that. And there's a number of them, whether you're looking at stocks like Teladoc or Zoom Video. A number of these stocks are kind of game changers that are taking advantage of this COVID-19 situation and just making a mint in the stock market. So a lot of those are part of the momentum factor. And you can see the momentum factor itself was up today when every single one of these other factors were down, and some of them down significantly. The value factor and the dividend yield factor were down over 2% today. The other thing I would point out when we're looking at these 6 different factors here is that the momentum factor is the only one above the moving average, and it's not even close. I mean, we are probably at the greatest separation on this chart from where the momentum factor is trading right now versus where its 30-day moving average is. Now look at the other 5 factors on the board. Dividend yield is bouncing down and away from a now falling 30-day moving average. Low volatility is down below its 30-day moving average. Quality is just a hair below its moving average. Quality has held up pretty good. That's kind of been the second best performer of these 6 that we kind of follow in my factor-based swing trading class. So quality kind of deserves an honorable mention, but still, when you're looking at momentum, way up here above its moving average, and then kind of second place is quality, which is just a hair below its moving average, that just goes to show you that this is a momentum market right now and nothing else. Everything is momentum. And then size factor is bouncing down off of a falling moving average, and the same thing can be said for the value factor. So sometimes you have just very slight differences in the different styles in the market. That is not the case right now. This is a runaway freight train for a certain part of the market, which is the momentum category, which includes a lot of those high-tech and work-from-home types of stocks. Everything else is kind of being left looking on the outside inwards. And so we'll see where that takes us. But the good news is many of those momentum stocks have very large market caps. And so when you're looking at something like the S&P 500 holding up much better than something like the Russell 2000, that's playing into that to a degree as well. Remember stocks like Apple and Microsoft and Amazon, which Amazon has just been rocketing here recently. Those companies are some of the most influential companies on the overall performance of the S&P 500. So in a way, it's large and mega cap tech that is kind of saving the day for the overall S&P 500, but the average stock within the S&P 500 is actually quite struggling at this moment in time, or at least they have been for the last month or so. So if you're looking for bullishness, then those momentum types of stocks continue to be where it's at this moment in time. Let's go ahead and take a look at some more charts now. Let's go over here to our 3 green arrows chart. And this will be chart 4D. And as we pull this up here, you can see that we've got, again, that divide that separates the left half from the right half. The 2 charts on the left half actually have 3 green arrows, which is a very bullish sign. The 2 charts on the right-hand side have 3 red arrows, which is a very bearish sign. Normally that doesn't work out that way. Usually you have maybe one of the charts with either 3 green arrows or 3 red arrows, and then the rest are kind of a mix of green and red arrows. But it is very rare to see 2 indexes with very bullish behavior and then 2 indexes with very bearish behavior at the exact same time. So again, just stressing the point that this is a very different type of a market that we're in right now. Real quick before I forget, over here on the factor selector as well, just to reiterate the point I was making a moment ago. Now this is a tool that I use for my Wednesday morning factor-based swing trading class, where we try to take advantage of those changes in the various styles that we're seeing out there. And that momentum category, once again, was number 1 for the 3rd straight week. Dividend yield was the last performer. So in that particular factor-based swing trading class, what we do from a practical perspective is we look at 2 bullish swing trading ideas coming from the best factor. In this case, for this week, it would have been momentum. And then we also look at a bearish or a short selling idea from a swing trading perspective in the worst performing factor. In this case, that would be the dividend yield factor. We've had quite a good hit rate in that particular class. In fact, we take coin flip trades, meaning that we have 1-for-1 reward risk relationships. So theoretically, our win-loss ratio should be around a coin flip as well. That's not what has taken place. Right now, we are winning 2 trades for every 1 that we are losing. So our success rate is basically 66 to 67%. That would be the equivalent of flipping a quarter in the air 100 times and having 66 or 67 of those times land on heads, which should not happen. So if you're interested in the idea of bounce trading and taking advantage of what you're learning from a factor basis, make sure that you are attending my Wednesday morning factor-based swing trading class as well. Today, we did teach our question and answer session. We had some great discussion about the Berkshire Hathaway and Dominion Energy deal that was announced over the weekend. So if you want to hear my thoughts on that, make sure you check out that if you're a premium member. That's on our posted as a recording on our calendar. And then David had an excellent class for portfolio management with ETFs and kind of transitioning his portfolio as a result of some of the things he's seeing with the US dollar right now. So make sure you're checking that out. And then tomorrow, of course, I've got my options for long-term investors class right away in the morning, where we'll be focusing on selling puts. And then David will be taking his students through some of the things he's recognizing from a technical analysis perspective. And remember, David has his CMT, so he studied long and hard for that particular designation. If you want to be trained by somebody who's gone through that rigorous test, then that is going to be the place for you. So if you are a premium member or a plus member of Market Scholars, make sure you join him for that class tomorrow as well. And then also, while we're over here, I wanted to say thank you to those of you that clicked like for me the last time I did this video on Tuesday. Looks like we got up and over 100, which is what my goal is. 103 of you did that for me. Please continue to do that. If you want the full-length videos, let's get them up and over 100. If you would prefer the shorter version of these videos, then no need to click like over there on Twitter. So I'll leave that up to you, so you can kind of vote for that on your end. All right, back on track with our charts now. Let's go ahead and now take a look at another chart setup. In this case, let's go ahead and transition our thoughts onto 12 grid analysis, starting with chart 5A. So with our asset class 12 grid, remember that by its very nature, we will almost always have a mix of green and red charts on this first set of 12 grids. Sometimes you guys will hear me say, well, we've got a clean sweep in one direction or another when we're looking at the global markets or we're looking at sectors. That rarely happens on this first set of asset classes because asset classes are by their very nature, in some cases, opposite to one another. For example, long-term U.S. Treasuries and the 10-year U.S. Treasury yield are nearly always opposite of one another. So anyway, just friendly reminder of that as you guys get used to listening to our analysis on these presentations. So let's go through a few of these charts here. Now, from my perspective, there's 3 charts that look superior when it comes to trends right now. The first one is gold, and I'm a broken record on that one. Been talking about gold for many months at this point, and we've taken many bullish trades in this very video as a result of that bullishness. So that should not come as a surprise to you. Now, we did have a little bit of a down day in gold today. Gold was down 0.27%. The US dollar was up 0.35%. Now, remember, the US dollar is now in a downtrend below a falling moving average with a strongly bearish posture. So this might be just a tiny little bit of a reversion to the mean before we kind of kick back into that downtrend. But when the US dollar is strong, that does pressure commodities. And you can see here that gold was down just a touch today. In fact, crude oil was down today as well. The other 2 charts besides gold that look really strong from my eye are right above it, foreign bonds, and then also foreign stocks emerging. So notice the difference here on the top line between EFA, which represents the developed foreign stock markets, think Europe, Japan, Australia, versus what's happening just to the right of us here with the emerging stock markets, places like Brazil, Russia, India, and China. In fact, I just got done putting a tweet together there for China Mobile on Twitter, for those of you that are interested in my thoughts on that particular company. But Chinese stocks have been erupting here recently, and I think that's been carrying the flag for the entire emerging market category. Now you'll notice emerging markets actually did close flat today, so they didn't finish up or down. They were exactly flat at 0.00, but on an intraday basis, so earlier in the session, we did hit a brand new multi-month high there on the emerging markets. And notice the difference between that and the chart just to the left, which is EFA, the developed foreign markets. We're not anywhere close to that high that we printed back on June 8th. And really the same thing can be said for the S&P 500, which we are still below the high that we printed back on June 8th for that particular chart as well. So the S&P 500 at least still has that dark green background color, telling us we still have that strongly bullish posture, unlike EFA, but neither one of them are as strong as what we are seeing out of the emerging markets right now. So keep your eye on some of those areas that I mentioned: Brazil, Russia, China, yeah, et cetera, et cetera. There's some pretty strong charts if you go through them out there. And then I mentioned before, foreign bonds. You know, the chart looks great on foreign bonds. It's just that you don't have as much opportunity to take advantage of it. And even if you did, you're not going to get fabulously rich off of, you know, trend trading the foreign bond market, right? But if you are looking for strength within fixed income, there is something to be said right now for BNDX. There is a nice little push into that area. And again, remember, that's going to benefit as well when the US dollar weakens, like we have in the lower left-hand corner here. That will benefit the trend of not just foreign stocks, which we talk about regularly in this presentation. We talk less regularly about the fact that it also benefits foreign bonds, all else being equal. So if you are expecting that US dollar to continue to fall, foreign bonds and foreign stocks could potentially benefit from that situation there. One other thing I'd point out before we transition our charts, I wanted to point out that the TNX really fell off of a cliff here today. Remember, this is the 10-year US interest rate. And you can see here, it was down significantly today. So on the think or swim charts, you do have to move that decimal place over to the left one. So the way that you would read this is that the current yield on the 10-year treasury is 0.60 at this point. So again, one of the lowest levels we have seen. This is taking us all the way back to that brief moment there on May 15th, and then prior to that we had a few times in April. But this is a dicier situation where market movement is pushing back into bonds here in the United States. Notice that TLT did very well today. It was up 1.6% at the same time that the stock market sold off. So if that continues to occur, we might see a pressuring of rates down there. And we've seen that kind of play through in another area as well. In one of my classes, I think it was the factor-based swing trading class yesterday, I was referencing how a lot of the home building stocks all of a sudden were starting to perk up, and even some of those home improvement stores like Lowe's doing well. So remember, that can be benefited by a falling interest rate environment as well. Some of those housing markets are still relatively strong considering the state of our economy right now. And part of that is because of what's going on, not just with people wanting to get out of city centers like Manhattan, where the coronavirus is a bit stronger, and moving out to the suburbs, but also as a result of interest rates falling, it makes those mortgages a little bit easier to digest. So there is still some demand for housing out there. All right, let's go ahead and now take a look at our next 12 grid. And this one is going to come in on the U.S. sectors. This will be chart 5C. As we look at this here, it's a little bit more of a mixed bag. There are times where we can get clean sweeps in the sector category where they're all doing well or they're all doing poorly. Right now, we really have a lot of differences out there. The area that struggled yet again today was energy and financials. Now remember, that was the exact same thing that I said on Tuesday, right? Because I was talking about, and then we brought your attention over to the sector selector that I put together over the prior weekend, showing that financials and energy had already fallen out of bed before the move on Tuesday. Well, here we go again. Just 2 days later, energy fell an additional 5%. I did talk about ExxonMobil in my, I had a student question about that in my Q&A session today. So if you're interested in my thoughts on ExxonMobil and the energy industry in a little bit more detail, feel free to check out that recording if you're a premium member. So energy falling off of a cliff yet again. Now notice that this is a third straight day where we've got oversold cluster signals. So it's telling us that the selling has come in hot and heavy here recently. That's one of the things that it's telling you there. Doesn't mean that it's an automatic buy, that all of a sudden we're just going to see that rip the opposite direction, but it is telling you that the selling has gotten extreme, so you should be vigilant at this point, looking for a bottoming process within the candlestick formations themselves. Right now, we don't have that, right? Each consecutive day continues to be lower, so we don't have any stabilization in the chart. But it's possible that we start getting there because the selling has gotten pretty aggressive here more recently. Remember, we just got an oversold cluster signal here on June 2nd. It did go up for 4 straight days after that, so that one didn't really pan out, or it didn't seem like it at the time. But had you sold on June 2nd, missed out on that rally for the next 4 days, and then looked back all of a sudden today, you're probably counting your lucky stars that you got out on that day. And now this might be a time, if you're one of those kind of reversion to the mean types of people, to start licking your chops a little bit, waiting for bottoming candles to start forming there on some of those XLE and oil and gas related charts. Financials also fell, not nearly as much, but they were down over 2% today. And kind of joining in there was the industrials. Industrials really struggling. I noticed a lot of those railroads kind of falling off of a cliff. Some of those car hailing businesses like Lyft and Uber struggling today. I did notice that UPS continues to be strong, and FedEx is holding up as well. I actually talked to a FedEx driver just yesterday by happenstance when I was taking my dog into a checkup, And he was saying that his business has never been busier. So I don't know if that translates into stock price performance or not, but he's basically, was saying that FedEx has been so busy he can barely keep up with everything. And you can imagine why. Everybody's cooped up in their homes and not really wanting to go to stores. And so, everything is getting delivered. And he was saying a big part of his business was delivering technology to people that are now working from home. And that makes sense, right? If you once worked in an office and all of a sudden they shut that down, you need to get, computer monitors and, all this new technology delivered to your home in order to do your job effectively. So anyway, the one area that seems to be holding up a little bit better there within industrials might be those package delivery plays. But otherwise, you got some struggles there in the industrial space. Remember, that's a very cyclical area of the overall market. So we should expect that when the economy is struggling, the industrials have a tough road to hoe in front of them. Now, the areas that seem to be holding up the best at this moment in time continue to be technology. No surprise there. Broken record, right? We've been saying that over and over and over and over again, and that's what we've been talking about on the sector selector as well. Well, we hit a brand new high on technology again today. Now, this is the market cap weighted version, so this is XLK. So big stocks like Apple and Microsoft are going to be controlling the price action here. As long as those two remain as hot as they have been, technology is more likely than not to continue its uptrend. You also see that communications is quite strong. Now remember, communications is going to include stocks like Netflix and Facebook and Alphabet. So a big beneficiary of the move to the internet and digitization of our economy while we're all hunkered down in our homes. And then I should also mention that discretionary looks pretty good all of a sudden as well. But I will mention here, because we are talking about the market cap weighted version, a big part of discretionary's move is as a result of what's been going on with Amazon. It is by far and away the most influential member of XLY, and you can see Amazon has basically gone straight up for the last 2 weeks. So don't let that fool you, I guess, is the point that I'm trying to make. I don't think XLY, when you start stripping away the mega cap companies, is as strong as XLK because the average tech stock is still holding up pretty good. The average discretionary stock doesn't look nearly as good, but XLY itself looks pretty strong as a result of Amazon. All right, so let's go ahead and get into our trade application example now. And for that, I'm just going to come back on over here to chart 3A. This is our swing trading one grid. And by the way, here's what Apple looks like. In case it wasn't obvious from the XLK chart, here's the actual chart of Apple. And no surprise, another all-time high. Warren Buffett's portfolio is thanking his lucky stars. He has Apple as basically half of his entire equity holdings in his portfolio because his banks and his oil companies and all of his more traditional plays are not doing very well. But fortunately for him, he is highly concentrated in Apple. Notice that Buffett gave away another $3 billion yesterday. That makes his grand total $37 billion. Many of you know I'm a big Buffett fan, so I applaud the guy. He worked his entire life. He's about 90 years old at this point. He worked his entire life trying to make the best returns he possibly could for him and his shareholders. And in the end, he's going to give away about 95% of his net worth to charity. And he's not the type of guy that's going to leave a family legacy or anything along those lines. He's not going to have a wing of a hospital named after him or have a library built in his honor or anything like that. He wants to give back to society, and I tip my hat to that type of behavior. So anyway, the charities out there can also be thankful that Apple has exploded to the upside. Let's go ahead and take a look here at the idea. And while I didn't mean for this to be a segue, I guess it could be a decent one. Costco. Now, it's not Buffett himself that's a big Costco fan, but his partner in crime, Charlie Munger, is a massive Costco holder. In fact, it's one of only 3 companies that he held. I don't know if that's still the case today, but I think that it is. Charlie Munger is highly concentrated as well when it comes to individual stocks, and Costco is one of his biggest positions. Well, Costco, of course, can benefit during the hunkering down of the coronavirus as well, because a lot of people hoarding consumer staples. And one place where you can get the most bang for your buck is getting those extra large shopping carts over at Costco and going through the warehouse and just loading up with toilet paper and tissues and food and you name it. Even big screen TVs these days they sell there. So some of those plays have kind of slipped by the wayside. Kroger hasn't done quite as well. Walmart has been doing a lot better, but that's only as a result of what I mentioned here on Tuesday with their big deal to potentially add a competitive subscription service against Amazon. So I don't think it's as a result of the coronavirus necessarily that Walmart's doing so well. I think they got a shot in the arm because of a separate news announcement. But Costco appears to still be benefiting from that idea of people hunkering down and trying to fill up their cabinets and their pantries. And so this was a nice breakout that occurred here today. Now, of course, I have the disadvantage of doing this video after hours here, so I didn't catch this breakout. But one thing that I always try to look for when I see a stock that I'm interested in that breaks out is where would the sold puts take me back to if this stock stopped going up. Now, that's not the expectation. Remember, when a stock breaks out, the expectation is that it will continue to go higher. And so now that we're well above those highs back in the middle of April, the thought process is that momentum should carry this stock higher. Then again, this stock has been mostly sideways for the last 3 months. In fact, it's underperformed the S&P 500 over that time period. And we've seen a bit more selling out there out of most things that are not technology oriented. So you just never know when this chart might turn right back around. So if you want to be less aggressive with taking a bullish stance on a stock, one way to go about that is by selling a put. Now, in doing so, you're going to collect a premium up front, but you're also going to put your neck on the line, and you're going to be on the hook for buying 100 shares of stock. That's especially important in this case. All of you are going to be at different stages in your life, and some of you might have smaller accounts, some of you might have bigger accounts. This is a large size company or a large price company at over $300. So remember, when you're selling a put, you're basically saying, I'm willing to buy 100 shares of that stock at a lower price. So at this point, you would have to be willing to commit, let's say, about $30,000 in this particular case, because it is such an expensive stock here. So for some of you, this might not be the right trade. But if you give yourself enough flexibility in price and room on the chart, maybe some of you that have larger accounts could be more interested in it. Now, one of the things that I tried to do here was look for a stock that is not expected to have an earnings announcement between now and the August expiration period. That's 43 days from right now. Costco is kind of a unique example of a company that's off cycle when it comes to earnings. You can see their last earnings report here was on May 28th. And so if you add 3 months to that, it's about August 28th is the expected next date. And of course, the August monthly contracts will have expired by then because they usually expire the third Friday of each month. So it's kind of a rare example of where you could sell a put on a stock and not have to worry about the potential landmine of an earnings announcement during the life of your trade. So what I typically do, in this case, I'm going to go out 20 to 60 days and look for the monthly contracts. So that brings me to the August contracts here with 43 days left until expiration. And then I look for an ROR closest to 1%. And you can see right here, I've got my ROR column on the put side of the equation. That brings us to this contract right here. That shows us 0.91% on the ROR, and that's the $300 strike. Kind of like that as well, because I like those nice round numbers. Oftentimes they can be used as kind of support areas. There might be people that are trying to buy that exactly at 300, and if that's the case, that could help support my stock and my bullish trade in this case for an option at around that level as well. Now remember, this stock is currently trading at 325. So by selling the $300 put, you're committing to buying 100 shares of it at 300 if it were to fall below 300. But in the meantime, you have a $25 cushion between now and when you might get yourself into trouble. And if we were to look at that on the chart right here, you can see that it would have to fall all the way down. Here's 300 off to the right-hand side. So, if I were to put my crosshairs on the chart there, it's approximately at about that level right there. And you can see that if you kind of scan your eyes left on my crosshairs there, that thin gray line does cut through a lot of those prior support areas. This was a stock that had really strong horizontal support at around 295 to 300 for 3 months, and it was just today that it broke out. So if this is a failed breakout and it decides to go back lower, there's a fairly decent chance it could catch some support at 300 anyway, which is where our obligation is. So let's go ahead and come back on over here to the trade tab. I'm going to click on the bid price here of the 300 August contracts. In this case, I'm going to try to get filled at $3 even for this $300 put. That would give me an ROR of exactly 1%. And I am going to put this in as a good till cancel order, so that way if it doesn't get filled tomorrow on Friday, it allows me the opportunity to get filled next week or the week after that or what have you. So let's go ahead and click confirm and send. Again, remember, you're going to spend about 30 grand out of your pocket if this stock were to collapse. So this is not for the smaller accounts out there, but for those of you that can take a little bit more risk and you think the setup is good enough, perhaps it's worthwhile to consider. So I'm going to go ahead and take my 300 bucks in to put my obligation out there at 300. We'll send that in and we'll see if we can get filled first thing in the morning. All right, well, thank you for joining me here yet again. If you got value out of my analysis here tonight, I would encourage you to go over to Twitter and click like for me. Again, the goal is to get that up and over 100, and you guys do a great job for me, and we really appreciate that. It allows David and I to get the word out about our organization to a much wider audience than we would be able to on our own. David will be back with you tomorrow with his always excellent analysis as well. And then I'll be back with you at some point next week, probably Tuesday. So anyway, until the next time I see you, best of success with your trades and your investments. Goodbye for now.